I'm the Chuck in the Markets up, Chuck. And, with some volatility yesterday, the market falling after having a pretty good run, it's got everybody's nerves on edge again. And so I thought I'd talk a little bit more. I've been talking all week about market volatility. I thought I'd go ahead and continue. The reality of it is, when they asked the venerable Ben Graham, the father of modern security analysis and the mentor to the likes of Warren Buffett, he made a very strong point, as I talked about in the blog, and he said that, investing is most intelligent when it's most businesslike. And he also pointed out, as I've talked about in previous blogs, that, in the short run, the market's a voting machine, which means people vote their shares, and of course they vote based on their emotional responses to whatever's happening in the world today. But in the long run, it's a weighing machine, which means the true business value ultimately, is what's most important. In other words, stock prices will eventually seek the value that they're truly worth. So I'm going to start here with a chart. This is a chart on O'Reilly Automotive, and my whole point here is what I'm looking at this is just a plotting of the earnings per share of this company. As you can see, earnings have been, very, very consistent growers, averaging over 18.9%. They went through the recession with a little downside in earnings, but they're expected to see a big increase because obviously this company sells auto parts, and it's one of the leaders in the world, and with the recession being what it is, people are fixing up the old clunker, so it's, holding up very, very well in the recession, all things considered. But the point is, when you look at it from the point of view of its business, the company has done extremely well. Now, what I've switched to here is a 4.5-year chart on, it's actually a 3.5-year chart, on showing O'Reilly Automotive's stock price movement. And, the title of today's theme was It Fluctuates, meaning the stock market fluctuates. And just look at the price movements from 1 year. Each of these lines represents a year. Here we have O'Reilly on March trading at 36. Then it fell all the way down to 28. Then it rallied all the way back up to 38. Then it fell all the way down to 22 by 2008 before rallying once again to a peak of 40 and currently trades at 37. So the point is, as you can see, the stock price has fluctuated quite a bit. This is, there's a couple of lessons here. The percentage moves are very, very severe, but the point I think that's most important in all this is there's no possible way that this business value, the value of this business, could be changing by this, these magnitudes in these short a period of time. Now I'm going to span this chart out to a little longer period. And again, I want you to notice that there's an awful lot of price volatility. And by the way, I'm only using monthly closing prices, and there's only 12 points connected in each of these years. If I put in weekly or daily data, you would see that this picture would even be more erratic or zigzaggy than it actually looks here. And so the whole point is stock prices fluctuate in the short run because, as I've also blogged about this, an auction market, and people are buying and selling or voting their dollars, as Mr. Graham said, and therefore prices are rising and falling in the short run or even longer term run based on emotions. Now, when you bring earnings back into the equation, and I've limited this just since calendar year 2000, just to make a point here, I want you to once again see that what really becomes important on this chart is the long-term earnings growth of the company or the business of the company. It's connotated by the green line. Stock prices have gotten above that more often than not over this period from calendar year 2000 than they did below it, as you can see. But every time the price gets disconnected from its earnings line, it ultimately comes back to earnings. And so the point is, this green line is really the ultimate, that's the line that shows what the business is doing, and that line is significantly more important than the price line. Stock prices are going to fluctuate. The reality is, I pointed out in Monday's blog, if you know what your business is worth, then you don't let the market hurt you. And in our view, based on this chart alone, I would say this is a $35 stock that's traded at 37, so I could argue it was slightly overvalued. I would have also argued that it was undervalued at 22 in June when it was worth 26, and then ultimately be worth 35 by the end of 2009. Having some sense of what your business is worth based on cash flows is fundamentally more important to you and will help you make better long-term decisions. This is Chuck Carnival saying I hope you enjoyed today's blog and look forward to talking to you again tomorrow.